From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for July 10th, 2026. Around the table today, I've got Art Rothschild, Tom Booth, Steve Giles, and looking back at the week, here's Kyle Tetting.
Well, thanks, Jason, and a bit of a correction from last week's show. I think I mistakenly called you Max. Good habits die hard. A good week overall for broad markets, although the Dow Jones Industrial Average down 0.5%, despite adding 149 points on Friday. Nasdaq up 1.7% this week, up 449 on the week, and the S&P up 92 points. That's 1.2%. To close the bell on Friday at 75.75 for the year. Nasdaq now up 13.5%, the S&P up 11.4%, and the Dow bringing up the rear up 10.4%, all including dividends. Hard not to start the week with a look, Art, at just how well the market seems to be doing, chugging along. It's not as if there's been a shortage of bad news, rough headlines, and yet here we are now more than halfway through the year, meaningfully positive on the markets, pretty ecstatic overall with how well things have gone.
I think it just emphasizes or reemphasizes the importance of patience. The pattern this year, as I've mentioned before, very similar to the pattern last year. Bad news in April with tariffs last year. This year, bad news through March with the war. We get a truce. All of a sudden, oil goes down, stocks go up. It's tremendous. Happy days are here again until the same cycle returns. It's like Groundhog's Day. But the market's wise to that from last year. It's wise to that from this year. So I think what we should expect as investors is more of the same throughout the rest of the year. Continued volatility. I think prices will continue to move higher. The rich are getting richer. It's a great time to be an investor. The weather's nice. It's a nice time not to be, indoors, be outdoors, enjoying it. So I feel very good. And when you look at the S&P as of the end of today, like you said, up 11.4% for the year. That's a good year if you can get it. And the Dow lagging a little up 10. That's a great performance for the Dow. New records being set on a regular basis. The Nasdaq, quite frankly, lagging relative to how it's pounded out gains in recent years. That's fine because it got a little frothy and there's a lot of stocks not yet participating in that. So again, happy days are here again. Let's just continue to watch it grow.
Yeah, and Steve, I think fair to point out that a lot of it does depend on where you're looking, right? That, for example, the NASDAQ versus the Dow, well, you've got a little bit of dispersion between those. More or less across the board, things are positive. But there's a deeper level to this in looking at a lot of these indexes and understanding that there may be some hidden risks potentially for investors out there that are solely focused on, for example, how the S&P is doing.
Yeah, the Dow Jones is not the entire market, nor is the Nasdaq the entire market. And if we think back to January and February, growth came out on a tear, kind of leaving value behind. In the second quarter, value has made up a lot of ground, and I think it's a great reminder, Kyle, that balance is a very, very important thing when you're building portfolios. We can't predict which sector is going to do better, and as Art pointed out, on again, off again war, whether you are thinking that this is going to be over this week or next month or next year, the point is that having a good balance to get through anything that the markets throw at you and anything that the economy throws at you is just good planning overall.
And Art, I look at the indexes and just how concentrated some of them have become. We got a bit of, I would say, a warning from one of the investment shops that we use more broadly. It was a marketing piece as much as it was anything else, really pointing out the value of active management. But when you look at something like the S&P 500, it's become incredibly concentrated, and that really has been the case for indexes more broadly.
Yeah, this wonderful fund company that wrote this piece, which again was self-serving because they manage over $3 trillion, and they do it very well, and they've done it very well for decades on a global basis. But they're pointing out the obvious. I mean, averages are averages, and a lesson we've always learned from, Bob was you get a deal. You're better off getting a deal than paying, what the average price is. So we like to make more with less risk, and that's one of the reasons why, as Steve suggests, we do diversify. It's why we do favor on occasion value stocks. Not everything's going to be in play all the time, and so if you have enough different things, you can get a smoother ride. We've seen this in our portfolios all year long. When the market goes down, our clients tend to lose less, and the markets go up, they tend to make less, but they're taking less risk to get there. And as this company pointed out, there is risk, in the indexes, just assuming that you're taking less risk because you're just going with the average. Not so.
Well, and the other takeaway there too, Art, is don't invest by looking in the rearview mirror. I think a lot of average investors will look at what did well in their 401ks and then buy what did well. That doesn't get them the good deals longer term. Stay balanced, stay focused on that allocation, and you'll do okay as long as you keep your eye on the price.
Bring this to the PhD level for just a second and look at how we define risk when we're investing, especially in the stock market. And I think so many of us look at an index and say, well, we are doing everything we can in the index to keep from putting all of our eggs in one basket, right? And the idea is this difference between what's called systematic and unsystematic risk. Systematic is the risks that are associated with just being an investor. Well, if rates go up, the market as a whole may go down. And unsystematic risks are all these things that are tied to the underlying name. And when we do some deep dives into kind of more financial theory, I can share that about 90 to 95% of the unsystematic risk, the risk specific to the underlying stock, is diversified at just 32 stocks. You don't need a portfolio of 500, 1,000, 5,000 names. You can get rid of most of that stock-specific risk with a very small number of names. Now, I think maybe you want a few more, but to add one more name beyond 32 isn't diversifying that much more than what you've already done. And so you don't need to buy the index to feel like you've properly diversified. And more importantly, in many cases, the index is not actually as diversified as you think it is, because it's, in the case of the emerging market index, for example, 30% in just 3 names. In the case of the S&P 500, 40% in the top 10 names. They can be incredibly concentrated because of the way they're constructed. And a lot of that has to do with the technology boom that we have seen, with the artificial intelligence build-out we've seen. And Tom, one of the things you and I were talking about earlier today is just how much that AI build-out has weighed on the inflation conversation.
Yeah, so the AI build-out has definitely made everything more expensive. Well, not everything, but the things that they need for it, like chips and turbines, which you sent a couple articles to us about. And then it also has increased the price for electricity as the data centers need more electricity. Increases the prices for other people. And then and also the chips that they use are used in cell phones and cars and other products that a lot of people use in the whole country.
Pricing ultimately is supply and demand driven, and we've had this massive uptick in demand from these data centers. It is difficult to spin up supply chain. It's difficult to spin up these industrial centers to be able to produce more quickly enough to keep up. And ultimately, many of these businesses are afraid to build too much because one of the questions is, well, when does this spending stop? I don't think there's an obvious end anytime soon. And the second part of this is that technology historically has been disinflationary. If we can do things more productively, long term, the hope is that it means that it costs less to do those things that used to cost more to do. The problem, as you rightfully point out, Tom, is that in the interim, you got a lot more demand chasing a limited supply of goods and services. Well, that's inflation, folks, and that's what we're dealing with. And that isn't something that necessarily the Fed has a direct say over. Art, we got an update from the Fed this week on kind of what they had been looking at in last week's meeting. Clearly, this is something that they are paying attention to, inflation more broadly. What have we learned from Warsh? What have we learned from the Fed more broadly?
Yeah, I'm liking this guy, and I'm kind of surprised. This is the second time that Trump has made, I think, a good appointment of someone to chair the Federal Reserve. And because it seemed like it was a politically motivated appointment, I think the fear was he was going to come in and immediately try to lower interest rates. But as we found out, he's a team player. He's been on the Fed before. He has definite opinions. He's a younger guy. Thinks we should study the way, and you've talked about this before, study the way we're using different information to make decisions. And most importantly, he doesn't want the Fed to guide the markets. He wants to listen to the markets and then read what they're saying before they set policy. And clearly in that last meeting, it was a unanimous decision to leave interest rates alone. A year ago, or last year when they were lowering rates, there were concerns about job losses. This year, jobs have perked up. So there isn't that importance of lowering interest rates. And although inflation has perked up and is double what they want it to be long term, you can put your finger on the temporary reasons that those prices are higher. One of which being this AI, build out the higher prices from that. The other tariffs, which keep rearing their ugly heads on a regular basis. The other is higher oil prices incident to the current war, and of course, a couple years ago, the war in Ukraine. So I just like the fact that they're listening. They're not committing to anything. And even though the investors are betting that they're going to raise rates sooner rather than later, I'm not so sure. I said that before in the show. I'm going to say it again. I think we could see some prices going down if we can get more stability, in oil prices, et cetera. And so we may not see increases in rates soon. But again, I like the way they're communicating, or communicating less, let's say.
Yeah, if anything, I think what I learned from the Fed is that by and large, they believe they're close, right? That there isn't this massive shift of policy that's necessary at this point. Maybe we're a little too restrictive. Maybe we're a little too accommodative. That's going to change month to month, quarter to quarter. But it's not as if we need to go from 0 up to 5.25 or 5.5 as we did going back a couple of years now. And it's not as if we need to go from that 5.25 back to 3 or 3.5. We've made those bigger moves, and now it's about fine-tuning in an economy that broadly has shown, especially labor market stability. The Fed's two objectives, price stability and stability in the labor market. Well, the labor market hasn't been the problem. We've been saying it over and over on this show. The data has continued to bear that out. Okay, here we go. Then let's focus on price stability. And the Fed has made clear that, they might not have a ton that they can do there beyond just being sensitive to how the data is evolving. And Steve, we're seeing it on the consumer side, right? That inflation isn't just, the prices to Microsoft building the data center. It's not just what the Fed's paying attention to, but so much of what we're looking at as consumers has gotten more expensive.
Yeah, that could even be like a bathroom remodel. But I think, the Fed might be doing something that nobody has considered yet, and that's resetting expectations of consumers. We went for 12 years, 13 years from the global financial crisis. This is when the real estate bubble burst. The Fed drove rates down to near zero, and they kept them there for the better part of a decade. It really wasn't until we started to raise rates to get back to a more neutral monetary policy that COVID hit. Rates went down again to address concerns with COVID, and then we kind of went through this whipsaw when inflation spiked because people were spending money and rates went back up. So it brings us to this point where the Fed now has what I would consider to be an historically more neutral monetary overnight federal funds rate. But consumers are still used to getting 0% financing on their cars. They're still used to getting 3% on their 30-year fixed mortgage rate. And as I've been telling my son, who is himself saving for his own house, hey, 6% on a 30-year fixed mortgage is not bad, considering that I know clients that were able to lock in a 14% 30-year fixed mortgage back in the 80s. 6% isn't bad, and maybe the Fed is trying to reset expectations by just pushing the pause button. For those of us that appreciate getting paid on our safe money, that have money in savings accounts and CDs and fixed income, I love getting 4% on my bonds. I think that's a great number. And it also keeps stocks honest. When you have something that can compete with stocks in the terms of a 4 or 5% interest rate on fixed income, it means that stocks aren't going to get out of hand because there's no other player in the game.
Our colleague Adam Bailey wrote about this a month and a half, 2 months ago for our newsletter, but just pointing out the earnings yield on the S&P versus the 10-year Treasury rate. And the earnings yield simply the price, the reciprocal of the price to earnings ratio. So earnings over price. And if you look at the S&P 500 right now, $1 invested in the S&P should get you about 4.9 cents of earnings over the next 12 months. Conversely, $1 invested in a 10-year Treasury is going to get you just a little better than 4.55%. So yeah, you get more to invest in stocks, but it isn't as big of a divide as maybe we've seen historically. And Tom, one of the things I know you've looked at is kind of how we have started to see the stock market come, in a lot of areas, come closer back to long-term averages for forward earnings multiples. It's not as if it's happening everywhere, but you're seeing some spots where perhaps maybe it looks a little more attractive on the stock market side.
Yeah, so as people's expectations for earnings this year go up, the forward PE has gone up for a lot of stocks, or gone down, actually, I should say. Sorry about that. And then it's kind of getting closer to the averages. So I was looking at a chart, and for large cap growth funds, it's at about 25.3 for the forward PE. And then the 20-year average PE is 20.1. For large cap blended funds, it's about 20.4. And then the average is 16.4. And then large cap value, 17.4 and 14.1 for the average. So it's definitely getting closer to the average. So it's nice to see that stocks in the future, next year and beyond that, might not be as expensive as they have been previously.
Yeah, we need those earnings to continue to grow, right? As investors, we're really investing in the future success of businesses in our country, or again, more broadly, if you're looking at your global investments. And so one of the ways we grow ourselves out of that valuation hole, right, having to pay too much for stocks is, well, let's let those businesses grow their earnings. Inflation helps. If businesses have pricing power, they can pass along that pricing power to the end consumer. It allows prices and ultimately the earnings to start to grow a little bit more quickly than maybe the economy more broadly. But the hard reality is we are still dealing with a market that looks expensive relative to history, that certainly isn't as attractive relative to safer things as it was 5, 10, 20 years ago. And so it is that kind of fine line of how do we allocate our money today versus how do we allocate it into the future. And Art, one of the things we talked about on the podcast last week was this idea of marginal utility. I know that's something you look at a lot with clients is how do we figure out the right risk reward based on all the opportunities that are out there?
Yeah, I loved hearing you guys last week suggest that we were going to be talking about that this week. And it does relate to what Adam's talking about. You know, you can get bonds with a steady yield versus stocks that entail risk. And what we do with our clients is for every client we talk with, every client we develop portfolios for, every client we help plan, we figure out how old are they, what are their objectives, what's their risk tolerance. And then we try to get them to compartmentalize. You know, cash is stable and steady. Bonds will provide you a good yield, but entails some volatility. Stocks are great for the long haul. So the marginal utility of buying stocks is exceptional if you have a long time horizon. The shorter your time horizon, the less marginal utility you have for buying something that's going to be volatile. So I love the term. It sounds kind of cool. But in practice, all it means is just have an appropriate portfolio for your short, long, and intermediate term needs and objectives.
No, I think that's fair. A couple of quick hitters this week, looking at the economic data that's out there. Consumer credit reported this week, saw a bit of a pullback in May, in particular in revolving credit. So that's credit card debt, folks. And good news, bad news. Bad news, fewer swipes of the credit card means that maybe consumer spending not carrying on at the pace that we had otherwise expected. Good news, it means there's fewer people spending money they don't have. One of the reasons, though, why revolving debt can come down is if you are filing for bankruptcy, eventually that revolving debt gets discharged, and we have seen an uptick in individual bankruptcies. And so part of the reason I think we're seeing that pullback in outstanding credit is because of those bankruptcies. But the good news there is the non-revolving piece, things like auto loans, still slowly ticking up. And then we got some housing data this last week. Again, maybe not the best of news on the housing front. Existing home sales trading at, or rather occurring at a 4.09 million seasonally adjusted annual pace. It's a bit of a step back, although higher year over year. But the thing that struck me was that we have a 3-year high number of people locking into mortgages. And folks, when you are looking at purchasing a home, you're talking to your bank to figure out, okay, what rate are you willing to give me? And do I think it's going to get better or worse? And if you're worried it might get a little worse, you might be willing to pay a little more right now to lock that rate in ahead of making the offer, ahead of closing on your home. And so more people locking into mortgages suggests that there are more homes on the verge of being sold. And so I am hopeful that it means that June might be a better month for home sales. We might see a bit of a pickup. Still problems with mortgage rates being elevated, still problems with housing prices being exceptionally high. But there is some data potentially suggesting that things might look a little better there as we look ahead. And then the other big headline this week was the second largest offering of shares that we have seen in our country, the first being SpaceX at $75 billion, but you now have a foreign company, SK Hynix, releasing almost $26 billion in shares as American depository receipts. This is a very big deal in the data storage space, going back to the conversation on AI. But again, in the grand scheme of things, it maybe isn't the biggest deal for most of our investors. Maybe the only other thing on my mind this week, and Tom, maybe one for you, since I know you and I have had this conversation with a lot of clients, but I've seen a lot of headlines from folks who think they might be dating Elon Musk in recent memory. And I think it's a good reminder of how we protect our clients, the kinds of things that are necessary to make sure that you aren't being taken advantage of. And specifically what I've seen is you get this rash of what are called romance scams, where maybe an older woman or an older man believes that they've fallen in love with this person online. This person online most recently pretends to be Elon Musk, whose assets are somehow locked up by the federal government and needs you, their significant other, to send them just a small amount of Apple gift cards so that they can convert it to Bitcoin. And we get these questions from clients sometimes, right, of, hey, I need to take some money out and maybe I'm not comfortable with where that's going. How do you help clients through those tougher conversations? What kinds of things are important to us as we help clients navigate some of those bigger picture issues?
Yeah, I'd say they should definitely question if they're getting messages online from people. The person you were referring to, I think I saw they were buying Tesla One, which, it sounds made up to me, but maybe not to everybody. But there's only one Tesla out there, so there's no Tesla One. But you should definitely just question everything. I think you mentioned before how if you get a call from like your bank or somebody, you should definitely call back on a number that you recognize and that is a legit number instead of just taking the call. I feel like, I don't know if it happens to other people, but I get calls all the time from numbers that I don't recognize and I don't usually answer. So sometimes, you should definitely question who the people actually are when you're getting calls and messages from people online.
It almost sounds silly. And when you're not in the moment, right, when you're not in the heat of that conversation, being promised the moon if only you'll turn over that $100,000 today, yeah, that does sound silly. But when you're in the midst of it, it gets a little bit tougher. And it's why it's so important that you have people in your life to reach out to, a financial advisor, an attorney, a friend, your children, whatever that looks like for you. But do not for a second think that there is anyone out there who is not going to give you the same deal simply because you asked your advisor a question about it. And so please reach out.
Sometimes things are too good to be true, so.
That's fair, and I think dating Elon Musk might be one of those. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.